Julia, let's kick it off with you. Market today, we looked like we were going to be in positive territory. We sort of tested some highs and then dropped back again. What did you make of the movements overall?
I think we have seen a little bit of technical selling coming into the picture today. The market we were watching was 5,996 points. That's a 7-year high that we reached a couple of weeks ago on the 3rd of March. We came within a point of that and we didn't manage to go any further. The market sold off after that. So we did see selling on the Australian share market, and quite unusual because we did see the Shanghai Composite gaining more than 1.5%. We saw the Japanese Nikkei up around about 1%, and yet the Australian market was down 0.3%. Having said that, the Australian market has performed very well in 2015 so far, and it's been the financials which has been powering along the market. If we have a look at the financial space, it's up 15% in the year to date. The property space is up almost 13% in the year to date. So we saw the banks taking a much needed break and a much earned breather today, and that was really behind what the step back we saw in the market. Outside of the banks, though, we saw the energy and the material space gaining ground, and that was really on the back of the weaker US currency, which has been great news for commodity prices. In fact, copper in New York was up 3.8% on Friday, and gold was up by 1.3%. So there were some bright spots, especially in that material space, but altogether the Australian market did underperform. And if we have a look at the last 52 weeks, this is a trend that is emerging, and that is that the countries and the stock markets where we are seeing quantitative easing are outperforming. The Japanese market's up 38% over the last 52 weeks. The German DAX is up 29%, and that's in comparison to the Australian market and the US market, which has gained around about 12 to 13% over the last 52 weeks.
Yeah, Michael, bring some company news. We were talking about some results that were released today, and of course a special dividend as well, helping boost the stock. The stock up 11.1%, right near the highs, or close to the highs of the day, I should say, but it did reach a fresh yearly high today. What do you make of this stock going forward as well? I mean, could you still buy in? Is there still room for this one to go?
We have a look at Premier. I think it was sold off with the rest of the retail space. We'd already heard bad news coming through from the likes of Kathmandu, Oriton, from Myer, and in fact, just since the Myer result, we've seen Premier shares down by 5% before today's performance. Now today they came out with a stellar performance despite the soft retail environment. Not only did we see that 21-cent dividend as well as a 9-cent special dividend, we know how much investors love yield in a falling interest rate environment, but sales was up by almost 5%. Gross margins managed an increase of 134 basis points. This is an environment from which almost every retailer we're hearing of margin squeezes, margins being cut and heavy discounting. So a really strong performance coming through. I think a standout was the Smiggles brand, which saw sales increase by almost 19%, and the UK expansion looks like it's going very well, and they're looking to open even more stores there before Christmas. So all in all, I think a very strong company, and remember, we're almost at the bottom of the retail. Most things move in cycles, and the retail space is very soft at the moment. Imagine when consumer confidence gets injected in. So Premier should do very well as the cycle turns as well.
Yes, to RCG as well, because this is another one we're watching. All-time record high for this stock today. 45% higher at the end of the close today after raising some cash to help pay for its takeover of Accent Group. What is so significant about this? I mean, and when you see it run as hard as it has, does it have any upside from here?
If we have a look at this acquisition, it is a big acquisition, but it's been an amazing run-up for RCG Group. Now, if we have a look at this Accent Group, they are acquiring it for 6 times EBITDA, so it isn't actually locked in yet because we will see Accent Group coming out with their results as of the end of April. So the price isn't actually locked in there. There's a range there. But if you look at Accent Group, they own the Dr. Martens brand, the Vans brand, and this is quite a transformational acquisition, I think, for RCG. We have a look at what it will mean. It will mean that RCG will move from 174 stores to almost double to 269 stores, and more than doubling its net profit. So if we have a look at this acquisition, it is a big acquisition. It will be materially accretive in the next financial year, but an amazing run for RCG shares given that they raised capital at 70 cents, and we saw the stock popping over $1 today.
Scott, what do you make of